All right, for this moving average strategy, it really works best in a trend. Okay, moving average and trend line strategies work best in trends, not choppy markets, not mixed markets. So it's very important to establish the direction. Okay, take a look at this for instance. When we have a dip down, when price dips down right here, okay, you can see that price will break down below the 20 EMA and the 50 EMA, and in red candles dropping down, but the moving averages are maintained in a parallel pattern above the 200. Everything's still in order. This is when the trend line breaks are the most reliable. I mean, the percentage rate's above 70%. When there's a crossing below the 200 moving averages, you're going to get a crossing of the moving averages. You're going to get the moving averages heading down, pointing in the other direction. That's a completely different kind of strategy setup. All right. The danger zone is below the 50 EMA, between the 50 EMA and the 200. Like it dipped right here. So this is the absolute lowest really for this trend line to be maintained, because a sharp drop will come right back up, and then you'll see a sharp drop to the 200 sometimes come right back up, and you barely got a bend on the 20 and everything is still consistently going up. That happens. That's okay. A sharp drop down to the 200 moving average, as long as these don't cross one another, as long as the 20 doesn't cross over the 50, it's still worth a try to go long. This is the best possible setup right here, okay? And so what we have here is a strong buy situation when that happens, okay? Now we have a buy situation when the pattern is below the 200. And what we have here is, let's see, right here, well, you can have a buy situation when price crosses the 20 and the 50. But if that's not above the 200, it's weak. Okay, it's weak. What we want is a strong buy pattern. Okay, and that's when price is above the 20, the 50, and the 200, and everything is going up, and it comes down. And the best setups are when it touches the 20 and the 50 EMA, the 20 and the 50 EMA, when these three are expanding in the same direction. All right, here and here. This wasn't a danger zone. This is an example of price pulling back in the danger zone right here. But the moving averages did not cross one another. This is also a very good setup. If we can get in this setup right here and ride it up. Okay, now when the moving averages cross, this is actually a sell signal. It's a weak sell signal because it's not below the 200 yet right here. But once it drops below the 200, then we have a strong sell signal. So what we would do in this case is probably on this bounce here, draw trend lines and look for selling opportunities. This would have been the best sell opportunity off of the caution zone as it pulls back into the caution zone between the 20 and 50. The caution zone's in between the 20 and 50. And when it starts to reverse, we know that price is, the moving averages has switched directions. We know that price, they're coming down, they're heading down. Even the 200 is flattened out and starting to tick down. So this is a sell signal. It's a strong sell signal when things are below the 200. It's just a sell signal when it's above the 200 if the moving averages are going down. Okay, strong buy signals are when everything's above the 200. Strong sell signals is when everything's below the 200. Okay, can you still have a buy signal and not be strong? Yeah, you can. When price is above the 20 and the 50 and it's not above the 200 yet, that's still a buy signal. Okay, when price is below the right here, for instance, when price is below the 20 and the 50 right here, that's a sell signal. It's just not a strong sell signal. Until it gets below the 200, it becomes much, much stronger. All right, these are some perfect examples on a perfect day. When everything is going in the right direction, right here, 10,000 tick chart, you see price pull back to these three areas. You see it pull back to the 20 EMA. We're looking for trend line breaks to go long. when it pulls back to the 50 EMA over here. For this would have been the last bounce on this, but that's still pretty good. The moving averages are not crossed. This is a dip down into the danger zone where it's coming close to the bounce off the 200. That's another area for the deepest pullbacks. As long as the moving averages don't cross, we're looking for this as a potential trade. Okay, when the moving averages cross, we have entered into a sell signal, but it's a weak sell signal. It's pinched in between these moving averages. It's actually in a danger zone, and it's not the same as this danger zone because the moving averages have not crossed here. This is a danger zone with the cross, and that means sell signal. This is not a sell signal right here. All right, this is not a sell signal because the moving averages have not crossed one another. This is still a buy opportunity. When the moving averages cross, then it's a sell signal, and then it becomes a strong sell signal when price drops below the 200. This is a very, very strong sell signal over here. Okay, let's see, what else do we have here? We got the best perfect buy opportunities on a good trending day that you just, it's over 70% accurate right here. When everything on your time charts is looking bullish, you start, well, here's an example right here. When price is above the 20 and the 50, it's not above the 200 yet. This is a buy signal, but it's weak. Once it gets over the top of the 200, it becomes a strong buy signal. This is really one of the best trade opportunities right here. It does dip below all the moving averages, but you wait for the close on higher time charts, breaking trend lines on lower time charts to all coordinate with each other. And then you get in when you get the trend line break or other opportunities. Bounces off all moving averages, bounces off the 20 here, bounces off the 50 here, bounces off the 20 here. The in between the 20 and the 50 is a caution zone. Caution zones are sometimes the best place to buy. It's also an area that is reversal. So you can see a consolidation reversal pattern take place in the caution zone also. Let's see what else we got here. All right, again, the example of strong sell signal. Why is this strong? Because price is below all three moving averages, below the 200 moving average, right? You don't necessarily have to wait for the moving averages to go below the 200 as long as price is below all three and they're heading down and they're bending down, angled down, I should say. It just gets stronger and stronger as the moving averages do drop below the 200. But once you get the cross, once price drops below the 50 and the 20, and then once price drops below the 200 and the moving averages are pointing down, because sometimes you'll get this where the price is below all the moving averages, but the moving averages are pointing up, and that's actually the time to buy. But we just saw that on the other chart where it dipped below all three moving averages, but the moving averages were still headed up. That's a different scenario. Okay, sell signals have to be where the moving averages are coming down, always. All right, so here we have price getting above what? The 20 and the 50, but it's still below the 200 right here. So it's a buy signal. It's just a weak buy signal. Once it gets above everything, it becomes a strong. Now here's some head faking for you, and you can't avoid that. Every strategy can get head faked. Every strategy has that weakness where the market can head fake the strategy. No strategy is 100% bulletproof, okay? And you just have to take your losses. When you have a win rate of 70%, you take your 30% losses and you're happy about that. All right, so here we have a couple of shakeouts. You might have been able to avoid this buy signal here if you were waiting for the moving averages, or at least one of them, to come up over the top of the 200 moving average. And you could have avoided all this until it got into the strong buy signal over here and just stayed with that. Had the trend line breaks right here in this opportunity off the 20. And that was the best trade on that whole entire leg up right there. All right. And here we have price dipping down into the danger zone. But again, the moving averages do not cross. So any type of trend line breakdown here would be a good, probably trade opportunity for the bounce. All right, let's see, what else do we have here? Again, with the sell signal, when price crosses under the 50 and 20, and when the 50 and 20 are headed down, because sometimes price will cross and they won't be headed down. you really want them to be pointed down. Okay, and even right here before the moving averages cross, they start to point down in this little area here, which is, once they cross, for sure this is the sell signal. If it's above the 200, it's a weak sell signal, but it's a sell signal nevertheless. Okay, here you get a head fake. Everything is going down. It looks really, really bearish. Look at these wicks bouncing off the 200 moving average. Boy, if that doesn't look like it's going down, I don't know what is. This yellow line, however, is a weekly low, which is a support level. And so using other time charts and other variables, we can kind of avoid some of this. And that's why we use, different time charts. The hourly time chart will tell us, hey, this is a support level, be careful. Or a daily high or daily low. And those are added to the system and makes it a stronger strategy. All right, so what happens here is it goes from a weak sell signal, head fakes, comes back up to a strong buy signal for a moment, and then drops back down into the danger zone where the moving averages don't cross, and sets up for a great trend line break, because now we have all the moving averages trending up above each other. They don't cross, dips down to the danger zone, and that's a good sign. As long as they don't cross, use the trend line break to catch that to the upside. A strong buy signals when all moving averages are going in the same direction and price is above all three moving averages. All right, I hope that's making sense. One more chart here, I think. Yeah, right here. Now you can see the difference between a weak signal over here, a sell signal, and a strong signal over here. And it just rides up and down for a while. And this is all strong sell signal in this picture right here. All right, so here we go. Sell signal because prices drop below the 20 and 50. Strong sell signal when it drops down in this area here. Right there. Strong. Okay. What else do we have? Here's a reversal of the price. Price pops back up over the 20 and the 50. That's a buy signal. If they're heading up, 20 and 50 are angling up. Whenever they start to angle up and price crosses above them, it could be a head fake. You need multiple time charts. You need other variables, ICT strategies. There's all Fibonacci's, support and resistance. You need to use this in conjunction or confluence with other things. But this is just basically the raw take on using the moving averages and when a strong signal and weak signals can exist. Okay, it becomes strong when it goes over all of it, but how strong is it when the moving averages are still below? That's your discretion. You have to understand that that the signals go from weak to strong. Okay, they go from weak to strong, and so you might have wanted to avoid the weaker signals, and here we have a strong signal that was head faked. Okay, and again, that's going to happen. If you have other time charts that are telling you this is coming off support, if you have other time charts that the hour time chart that's telling you, hey, this looks like a good reversal, then you can use that other information to ignore this drop down here and say, I'm going to take this trend line break anyway. Boom. And when it comes back up over the top, I'm going to get in, and it's a strong signal again. I'm going to get in. You would have avoided shorting here if you could have other reasons on other time charts to avoid this, especially if it's at a daily support level or an hourly support level or a Fibonacci level where it's time to reverse. Okay, so again, not every strategy is 100% perfect, but you try to find a strategy that has a high win rate. Caution zones, danger zones, okay? Caution zone and danger zone. The danger zone is when price falls. If you're going long, danger zone is between the 50 and the 200, right? Between the 50 and 200. Danger zones can be great for bounces. They can also be, it's called danger for a reason because it dips so far. It's the absolute lowest it can dip before these moving averages cross. Once these moving averages cross, it's time to, there's a sell signal. It's a weak sell signal, but it's a sell signal. And you need to think about not going long and potentially going short. Okay, here it bounced in the danger zone, but created trend lines, consolidation, and a push back up. So it was a good chance to buy here. Here it fell in the danger zone and completely crashed. Here it fell in the danger zone over here and was a good bounce. But still, we need to understand that. Okay, now the caution zone, well, one more. Here's the danger zone consolidation, double bottom reversal. Beautiful. Trend lines drawn this way. And you take the break or the consolidation breakout. All right. What else? Caution zone is just in between the 20 and the 50. 20 and the 50. Anything in between the 20 and the 50, right? So if you were going, this is a sell signal here, becomes a strong sell signal. It bounces up into the caution zone for buying long. You're not going to want to buy long on that. It's in the caution zone, and it's coming off of a sell signal, right? And if it goes into the caution zone coming off a sell signal, you're not going to go long there. You're going to go short, okay? Now here we see the caution zone. Again, caution zone is an area that it could reverse. Caution zones are areas to consider taking a trade in the same direction. Like this would be an area to continue to go down, or it's caution, it might reverse here. Once price comes up over the top, then we have a weak signal to a strong signal, and it chops around a little bit, but you get the picture where we're using strong and weakness. But again, showing this without the use of other convergences, confluences, and other harmonies and other time charts, you're going to see weakness, you're going to see failure, and it happens with every single strategy out there. There's no strategy that is 100% perfect. What we want to do is find strategies that are reasonably win rates when done properly, and just take a higher win target than a loss, and just go 2 to 1. 2 to 1 with a 70% win rate, 2 profits to 1 loss is going to be a profitable strategy. So hopefully that's what this will become. All right, we'll see you on the next video. God bless you. Peace.